Hey guys, this is RG and I'm back with another video. Today I wanted to talk about Apple stock, ticker symbol AAPL. This stock made some headlines last week and I wanted to give you my thoughts. Goldman Sachs downgraded Apple to sell, citing the economic slump for a near-term decline in device sales. The bank lowered its price target for Apple shares to $233, implying a nearly 20% drop from its current price of over $280 a share. Weakening demand will push iPhone sales down 36% in the second quarter, according to analysts, which will persist into 2021. Despite the revenue slide, Goldman expects Apple customers to defer buying the iPhone for now, instead of switching to other less expensive options. Before I get into my analysis of the stock, I just want to say that Apple is an amazing company that has innovated and found a way to continue to produce products that people absolutely love. It's also one of the world's most profitable companies. In 2018, it ranked as the second most profitable companies in the world, behind the oil juggernaut Saudi Aramco. Apple designs, develops, and sells consumer electronics, computer software, and online services. It is considered one of the big four technology companies alongside Amazon, Google, and Microsoft. The company's hardware products include the iPhone, iPad, Mac, iPod, Apple Watch, Apple TV, and the AirPods, which have become one of the hottest items out there. Even though most of its business revolves around selling products, it also offers a wide variety of services, which includes iTunes, the App Store, Apple Music, Apple TV, iMessage, and iCloud. It also has the Apple Store as well as Apple Pay and the newly introduced Apple Card. Apple is in a highly competitive market, and the company is confronted by aggressive competition in all areas of their business. These markets are characterized by frequent product introductions and rapid technological advances that have substantially increased the capabilities and use of smartphones, personal computers, tablets, and other electronic devices. Many of the company's competitors that sell mobile devices and personal computers that run on other operating systems seek to compete primarily through aggressive pricing and very low cost structures. Nevertheless, Apple appears to continue to have an advantage when it comes to performance, product service quality, reliability, design innovation, ecosystem, and overall corporate reputation. Some additional challenges and risk factors include adverse macroeconomic conditions, including inflation, slower growth or recession, as well as tariffs. Throughout the years, though, Apple stock has performed incredibly well. It has consistently outperformed the S&P 500 as well as other technology indices. At its all-time high, Apple stock was trading at almost $330 a share. During the recent stock market crash, the stock took a hit and it dropped to about $215, but has since then bounced back and is currently trading at over $280 a share. Apple currently has an EPS of 12.6 with a PE ratio of 22.45. It is difficult to compare Apple to any other company since it is unique in that it offers one-of-a-kind products and services, and it doesn't really resemble a conventional consumer electronics company. Nevertheless, the PE ratio appears to be relatively high in comparison to its past recent history. Apple has a market cap of $1.2 trillion, which is tied for second with Amazon and trailing Microsoft. Before we get into the financials, let's take a look at how Apple generates most of its revenue. Most of its revenue is generated via the iPhone, followed by its services and the Mac as well as its wearables. However, while the iPhone and Mac's year-over-year revenues from 2018 to 2019 haven't fared well, Apple services and wearable accessories have grown nicely year-over-year from 2018 to 2019. Now, approximately 45% of Apple's revenues came from the Americas in 2019, followed by Europe and China. Notice that the year-over-year revenue in Europe and China dropped noticeably between 2018 and 2019. This was attributed to weakening iPhone sales, as well as weakness in foreign currencies. Apple's revenue was $260 billion in 2019. Overall, its revenue has been increasing since 2015. However, Apple's revenue did decrease by over $5 billion between 2018 and 2019. Similarly, its net income decreased by over $4 billion during the same time period. This is somewhat concerning. Its EPS was $11.97 per share in 2019, which has increased since then. Surprisingly, Apple was able to maintain its EPS at the same level from 2018 to 2019, which is surprising when you consider that their revenues and earnings declined during the same period. I also noticed that Apple shares have consistently decreased since 2015, which means that the company has been buying back its own stock. This explains why it was able to keep its EPS relatively high in 2019. With this in mind, it is fair to assume that much of Apple's recent stock performance can be attributed to its aggressive stock buyback program. The company's decline in revenues was largely driven by lower net sales of iPhone, partially offset by higher net sales of wearable accessories and services. Now let's move on to the balance sheet. I generally like to focus on assets and liabilities. As you can see, Apple's current assets are considerably higher than its current liabilities, as shown in red. In fact, at the end of their 2019 fiscal year, they had over $100 billion in cash, which is considerable. Also, Apple's total assets were considerably higher than its total liabilities, which means that they won't be having any issues in the short term or long term. They have a lot of debt, but they have plenty of assets to cover their liabilities. Now let's take a look at the cash flow statement. I want to focus on cash flow from operating activities, investing activities, and financing activities, all of which are highlighted in green. Cash flow from operations is the cash flow associated with the core business, typically associated with the sale of products and services. Cash flow from investments is the cash flow associated with business investments. This can include machinery and equipment or the acquisition of another business. This figure is oftentimes negative. However, in Apple's case, it's net positive and attributed to the sale of an investment, such as a treasury. This is a really great sign. Cash flow from financing activities is the cash flow associated with raising, borrowing, or repaying capital. This also includes things like dividend payouts and stock buybacks, amongst other things. The most important number, in my opinion, is the net change in cash, shown in red. This is the sum of all three categories, and it tells you whether the business is increasing or decreasing its cash balance for the fiscal year. A negative net change in cash can be concerning if the company does not have sufficient cash on the balance sheet. In Apple's case, they went into the 2019 fiscal year with $25.9 billion in its cash balance, and they added a total of $24.3 billion, which resulted in a total cash balance of $50.2 billion at the end of the fiscal year. Overall, I don't have any serious concerns with any of their financials. They look solid. However, their negative cash flow from financing activities is incredibly high. So let's quickly take a look at this breakdown to see why this figure was so large. So as you can see, Apple's net cash flow for financing activities was negative by almost $91 billion. However, it is easy to see why this is the case. They spent about $67 billion in 2019 on stock buybacks. That accounts for nearly 75% of the $91 billion expenditure in 2019. Keep in mind that many companies do this in order to drive up stock values. Nevertheless, it shouldn't be a problem for Apple with such large cash balances. Overall, Apple's financials look fine, although there are some areas of concern. My first concern is that they had declining revenues and earnings year over year between 2018 and 2019. This can become a real problem if it persists, especially when you keep in mind that we may be entering a recession, which may continue to impact their revenues and earnings. The second issue is that it appears that iPhone sales are no longer increasing year over year. However, this sounds like it's being addressed since Apple is beginning to transition from a conventional electronics hardware company to a services and media company. Keep in mind that they continue to do well within wearables and accessories, with year-over-year revenues increasing. The third and final issue is the amount of stock buybacks. Apple appears to be buying back its own stock at a higher rate than almost any other company out there. This may become an issue as revenues decline, which will compromise their ability to buy back its own stock. Nevertheless, this company continues to be a cash cow, and they continue to be one of the most profitable companies in the world. In 2019, they still managed to bring in over $55 billion in earnings. Keep in mind that during the same fiscal year, Amazon brought in $11.5 billion, Microsoft made just over $39 billion, and Google was at just over $34 billion. Nevertheless, I think that with Apple's PE ratio hovering around 22.5, the stock is a bit pricey With the upcoming recession, my assumption is that the stock price will come down. Still, I believe that Apple stock is always a buy, but I think that you will be able to get it at a better price after its Q1 and Q2 earnings. The company will also benefit greatly with its iPhone 5G, which is expected later on this year. This product should help boost their iPhone sales well into next year. That is going to do it for this one. If you guys enjoyed the video, please feel free to hit the like button and subscribe. It really helps me out. I'll see you guys in the next one.